Today, we will talk about the current ratio. The current ratio measures a company's ability to pay short-term obligations with its current assets. The current ratio is a liquidity ratio that measures a company's ability to pay short-term obligations or those due within 1 year. It tells investors and analysts how a company can maximize the current assets on its balance sheet to satisfy its current debt and other payables. A current ratio that is in line with the industry average or slightly higher is generally considered acceptable. A current ratio that is lower than the industry average may indicate a higher risk of distress or default. Similarly, if a company has a very high current ratio compared with its peer group, it indicates that management may not be using its assets efficiently. To calculate the current ratio, you compare a company's current assets to its current liabilities. Current assets listed on a company's balance sheet include cash, accounts receivable, inventory, and other current assets that are expected to be liquidated or turned into cash in less than 1 year. On the other hand, current liabilities include accounts payable, wages, taxes payable, short-term debts, and the current portion of long-term debt. The formula for the current ratio is calculated by dividing current assets by current liabilities. The current ratio measures a company's ability to pay current, or short-term, liabilities with its current, or short-term, assets, such as cash, inventory, and receivables. In many cases, a company with a current ratio of less than 1.00 does not have the capital on hand to meet its short-term obligations if they were all due at once. Conversely, a current ratio greater than 1.00 indicates that the company has the financial resources to remain solvent in the short term. However, because the current ratio at any one time is just a snapshot, it is usually not a complete representation of a company's short-term liquidity or longer-term solvency. A current ratio below 1.00 indicates that the company's debts due in a year or less are greater than its assets. However, different situations can negatively affect the current ratio in a solid company. For example, a normal cycle for the company's collections and payment processes may lead to a high current ratio as payments are received, but a low current ratio as those collections ebb. Large retailers like Walmart, which have been able to negotiate much longer than average payment terms with their suppliers, may also have a low current ratio. A high current ratio, such as more than 3.00, could indicate that the company is not using its current assets efficiently, securing financing very well, or properly managing its working capital. It is important to place the current ratio in the context of what has been historically normal for the company and its peer group. The trend of the current ratio over time is crucial in understanding whether a company's financial position is improving or declining. An improving current ratio could indicate an opportunity to invest in an undervalued stock amid a turnaround. Conversely, a declining current ratio could harm the company's valuation. Comparing the measure across industry groups and trending information are some weaknesses of the current ratio. Here are 3 key takeaways. 1. The current ratio compares all of a company's current assets to its current liabilities. These include assets that are cash or will be turned into cash in a year or less and liabilities that will be paid in a year or less. 2. The current ratio helps investors understand more about a company's ability to cover its short-term debt with its current assets and make apples-to-apples comparisons with its competitors and peers. 3. One weakness of the current ratio is its difficulty of comparing the measure across industry groups. Others include the overgeneralization of the specific asset and liability balances, and the lack of trending information. Hope this would help. Thanks for watching.